Good morning, everybody. Good morning, good morning, good morning. It is Friday the 13th. And quickly going over here, I was 2 seconds late from getting the chart ready. It's Friday the 13th. 27 years I'm doing this. I have never traded on a Friday the 13th, and I will not be trading today. As I've shared there in the email, I've got a couple of January 20th puts just so I can be a participant because everything is saying you've been at the buffet too many hours and you've eaten too much food. We're not refilling it. Three green closes in a row. And the one red close that we got, which was on Tuesday, was only down 3 points. So call it what you want, but more or less, we've been on a 5 day run since that January 6th rally that we had, which we already knew we were going to get. And that's the reason why we were already in the calls. And here we are heading into Friday the 13th. Earnings is kicked off, and warning signs, warning signs, warning signs, warning signs, warning signs, but more importantly, warning signs on Fridays. Fridays suck. Didn't do this one because I don't remember why, but I'm going to do it now because color coding helps you see everything without having to look at it. Friday we closed green. The prior Friday we closed red. That was the end of the year. Doesn't matter. We had a green close on December 23 before Christmas. Prior to that, we went through red closes like you wouldn't believe on Fridays. Fridays suck. Fridays hate closing green. And we've got a whole bunch of reasons as to why we shouldn't close green today. But then again, we've also got some warning signs as to where we won't close green if we don't. Here is your 15-day view just so that you can see the move off of the December low. As I had projected, move up here, move down here, move up here. Didn't quite get as low as I wanted it to be there on Tuesday, thus I missed out on this run up here into this week. Happens. I've had girls text me and my phone was low battery, or I didn't look at it and I missed the text. Hey, happens. Anyway, we are above the 200-day average, 5-day, 50-day, 10-day, 100-day, 20-day. So from every aspect of it, there is absolutely no reason to be pounding the table and getting short in a close to expiration date, something like a January 13th or a January 20th or even a January 27th. I caught that whale in the alert room on yesterday that I posted there. Where was he? The whale. Yes, I caught a whale. I was over there scanning, seeing what was going on, and this guy bought 15,000 February 17th SPY 395 puts at $8.20. I looked over, see if there was a combination, if there was something getting rolled out of. Straight up buy. $12.3 million buy on those 395 puts. $8.20. He is clearly making money. 395 minus 8. Do the math. It's right there for you. He is obviously looking for a move down to around 385. That's what I'm looking for, is a move down to around 385. Somewhere down here around 385, 387 on SPY. Get that move down, and then from there we should have these too quickly overbought time frames that we've got sold down, and then we can start looking at our calls, heading into the FOMC meeting at the end of the month, heading into the big tech earnings the last week of January. Caterpillar, little gap to fill. You got this big gap to fill back here from last week Friday, and new all time high again here pre market, pushing that 260 area. Definitely one to watch, but it caught my eye when it popped up above 250. And you know what? This thing, it's on its own right now. Shit just ain't gonna work today. It'll work in a week. It ain't gonna work today. The Dow. You see this 34 180 and how this was your pop, your bounce after we had that little shakeout there in February last year. A little bit of a bounce there in March. Then we had that breakout. It was also your August highs. And over here back in November, we were pushing up above it, and we did the same thing in the beginning of December. over there in the middle on the FOMC meeting. And here we are again, right back at that same spot. But again, every index out there, every one of them, they're all screaming overbought. All of them are screaming the exact same thing. And more significantly, on the VIX, since we lost that 2102, it has crumbled through the August low, and it is pressing on the April 22, the 2022 lows, right down there at 1845. As I've shown you there in the email, the look on the failed breakouts that we've had, you can go ahead and put the combination there as to where the VIX was when we had the August high and when we had the March high, right there at the end of March. I can't be as bullish as I want to be, even though I am talking about those levels that I'm expecting us to be headed to in the medium to short time frame, only because I've got all these warning signs over here. And until these warning signs get cleared up, it's unfortunately going to be continue to be the exact same thing, and just sitting there waiting like two mice that fell into a bucket of cream. Now, one of them is going to sit there and drown. That's the one that's going to continue to buy short-term puts in very big ways. And the other one's going to turn it into butter. And that's the guy that's going to be sitting back, waiting. Let it dip. Go ahead. Let it dip. And after it dips, buy. And when we break above that 4100, 4100 in September, start looking at 43.25. After 43.25, we can start looking back up at that 45 area. 45.12, 45.85, but not until we can get a little dip. A dip. Not a bear market, a dip. Have a great morning, 3-day weekend. Anybody want to do one-on-one calls with me? I've got a funeral to attend tomorrow. Other than that, I'm wide and free. Send me a message. Happy to do them. Saturday, Sunday, Monday.